What is happening, investors? It is your boy Jack. I'm not a financial advisor, and today we're going to be speaking about 3 companies that pay monthly dividends. I'm sure you're all aware of what dividends are, and you probably know that in general dividends get paid out quarterly, every 3 months. There are, however, some companies out there that for whatever reason decide that they pay out their dividends every single month. Now this does not mean that you actually get paid more in dividends, you just get paid more often. If a monthly paying dividend company has a 10% dividend yield and a quarterly paying dividend company has a 10% yield, you will get paid the same over the course of a year by both. Some people just like getting paid monthly. So today we're going to be covering 3 companies, okay? 2 of which I do indeed actually own, 1 I don't, but I may well be getting into relatively soon. If you enjoyed today's video and you get some value out of it, can I ask you to please smash that like button? It helps me out absolutely massively. If you're new around here, please subscribe. We're trying to get to 10,000 subs. We're nearly there. It is absolutely crazy. And of course, drop me a comment down below. Let me know if you're in any of these companies or if there's any other monthly paying dividend companies you personally like. So with that being said, we won't waste any time. Let's get to the very first company of today. So the very first company we're having a look at today is Realty Corp. And more than likely a lot of you guys do actually know who these guys are. So these guys are an REIT. They're a real estate investment trust. They have a current dividend yield of 4.55% and they have a dividend safety of 70. They also have a dividend streak of 25 plus years, okay? And that's not very common to see in REITs whatsoever. Now, if you don't know what these guys do whatsoever, okay, essentially, as of right now, they own more than 6,400 properties across America that are leased to about 300 commercial tenants in 50 different industries. So, you know, they have some absolutely massive tenants, people like Walgreens, 7-Eleven, FedEx, lots of massive names. So a few really nice points about these guys, okay? Their occupancy rate has never dipped below 96% even during the financial crisis. Absolutely fantastic. They don't bet on any one client or industry for its future success. A high occupancy rate would be of little value if a single tenant accounts for a major portion of rent, example 15% plus, and goes under or decides to walk away. So the largest tenant they do have is Walgreens, and that only accounts for 6.1% of their income. Then you have the 7-Elevens, Dollar General, FedEx. This company's compound average annual total return since 1994 when they went listed has been 14.6%. That is massive. And the compound average annual dividend growth since 1994 is at 4.5%. You can see that here by this chart. That dividend just goes up and up and up. And as of next month, they'll have paid dividends 600 months in a row, people. A quick look at the balance sheet, we can see total assets of 18.7 billion and total liabilities of 8.3 billion. So debt-wise, these guys are in a fantastic position. Now, these guys have paid out 81% of its adjusted funds from operations as a dividend, but for an REIT, that's not actually very bad whatsoever. And we can see here that below 90% is the preference, and that has been going down and down and down over the last number of years. Now, forecasted it could go up a little bit, but you know, that's happening to everyone right now. And another nice thing that just gives me even more confidence in these guys, okay, their sales were relatively stable during the financial crisis, as demonstrated by their 0.8% dip. And obviously, as we've established, they continued paying their dividends and grew their dividends during that really tough period of time. Right now, Realty is still down 25% from the recent high, so they're still down a considerable portion compared to where a lot of other companies are right now. And the recovery hasn't been anything spectacular. They've gone up about 40%, which is obviously very good from the absolute bottoms, but I mean, a lot of companies have done far better. As far as dividend companies go, and as far as relatively safe dividend stocks go with a decent payout, I mean, that 4.4% yield, I really like the look of Realty. I think this is a nice price point to get into. I'm up in my position and I'm still willing to buy more at this price. I mean, again, this number here, that 14.6% compound average annual total return since 1994, that is fantastic and has outperformed an awful lot of the market. So that's it for Realty Income. We'll go on to the second company of today. Okay, so second up today, the company I don't actually own just yet, is LTC Properties, and these are another REIT. They're a healthcare REIT specifically. So they have a current dividend yield of 6.04%, so a very attractive dividend, and that is accompanied by a 52 dividend safety score. So as of right now, they have a 17-year dividend streak, okay? But they have no dividend growth streak. The dividend has just stayed where it is for the last few years. But it is already at 6%. You know, it's already a very big dividend. A quick look at the balance sheet. Total assets of 1.5 billion and total liabilities of 718 million. So again, a fantastic balance sheet. Now, what do these guys do? Okay, they have 180 plus investments in 27 states and 30 operating partners. They invest in seniors housing and healthcare. Their portfolio is comprised of approximately 50% seniors housing and 50% skilled nursing properties. So they target states with the largest projected growth in the population of 80 plus year old Americans over the coming years, which comes out to be Texas, Michigan, and Wisconsin. So they operate under a triple net sale leaseback model, which means that they will acquire a property from a facility operator and then lease back the use of that facility under a long-term 10 to 15 year leases with annual rent escalators built in to counteract inflation. And under this model, the tenant is responsible for maintenance, taxes and insurance. And one thing I like about these guys, in the somewhat short to medium term anyway, is that medical REITs, which specialise in senior housing and skilled nursing facilities, should enjoy higher demand in the future since the growth rate of Americans aged 75 plus remains much faster than the population as a whole. Now the max stock chart for these guys in general is very nice. There is lots of upwards growth, an awful lot of upwards growth with its fair share of downwards movement as well. Thing is though, from the recent highs again, these guys are still down about 25%, so to me it seems like it could well be a good time to get in. Their PE ratio is currently at 12 as well, so quite a nice number in general. As far as high paying dividend companies go, you know, those companies that have the 5-6+% dividends, I very much so like the prospects that these guys have. I even think the growth prospects are very good. One last thing we'll have a quick look at, okay? They reported Q1 EPS of $1.60. $1.08 better than the analyst estimates. Revenue for the quarter came in at 38.04 million versus the consensus estimate of 37.66 million. So here's some transactions that these guys were able to do in the first quarter of this year. Acquired a 140 bed skilled nursing center in Texas, and they entered into a 10-year master lease with an initial cash yield of 8.5%, escalating 2% annually with 2 5-year renewal options. Completed the sale of its Preferred Care Inc. portfolio with the sale of 21 skilled nursing centers. Completed construction of a 78 unit senior housing community, and they purchased 615,000 shares of its own stock at an average price of $29.25. So all being said, I do very much so like the look of these guys. I don't think they're ever going to have a massive position in my portfolio, but I do actually plan on picking up a few of these, maybe next week, maybe the week after. They're on the watch list now though. I'll be keeping a good eye on them. So our final company of today is Pembina Pipeline. It's not another REIT. There were a few more REITs we could have thrown in there, but Pembina Pipeline is a company I very much so like. So these prices are in Canadian dollars, but anyway, we go down. These guys are still down close to 35% from the recent highs. These guys have a 7.26% dividend yield and a dividend safety of 80, and they have an uninterrupted dividend streak of 23 years. Now it is only a growth streak of 8 years, but it's still a fantastic dividend nonetheless. So if you don't know who these guys are or what they do, they're a major transportation and midstream service provider with a network of oil and gas pipelines, storage facilities and processing plants located primarily in Western Canada, in Calgary I do believe. So as the name would suggest, their main place of business is in pipelines, okay, which accounts for 58% of their EBITDA. They transport crude oil, natural gas liquids, condensate and natural gas across much of Alberta as well as parts of British Columbia and the US. Facilities, 29% of EBITDA. They own natural gas processing and natural gas liquids fractionation facilities that provide customers with natural gas, condensate and NGL services. And they market and new ventures 13% of EBITDA. Through their first 45 years of existence through 2000, the company focused only on oil and condensate gathering with its conventional pipeline operations. In 2001, the firm added heavy oil lines and expanded into crude oil marketing in 2005. In 2009, they started processing gas, and in 2012, the company acquired Provident Energy to get into the NGL business. And they went ahead and bought a company called Vereson in 2017, which further expanded its gas pipelines and processing infrastructure. Basically now they do it all. Now a quick look at the balance sheet. We'll look at the total assets that are at 24.2 billion and the total liabilities that are at 11.9 billion. So again, a fantastic balance sheet. But when we look at these guys' max stock chart, okay, there was only one real period of time, aside from the time we're in right now, where we saw any sort of a really big crash, and that was here between 2014 to 2016. And that was a relatively slow recovery if you were one of the very unfortunate people to buy up here. I mean, literally they had only reached new all-time highs just before this massive crash came and happened. And what happened in 2014 to 2016 was volatility of pipeline politics in Canada and the 2014 to 2016 energy crash. You will see a dip like this among an awful lot of oil or energy related companies in 2014 to 2016. They do have that 7+% dividend yield though. They have a good balance sheet and they have been hammered to the ground. I personally believe they are at a very good price right now. As I said before, I do own them. If you want a different midstream oil related company to have a look at as well, I also own EPD, Enterprise Product Partners. I absolutely love these guys too. I actually only spoke about these in yesterday's video. They actually have a dividend yield of 9.32%. But anyway guys, that is it for today's video. So guys, that is it for today's video. Those were the 3 companies that, you know, if you want to get paid a few dividends every single month, you can go ahead, have a little bit of a look into them, do some more research, and then, you know, decide what you want to do. Do remember that just because these companies pay their dividends monthly instead of quarterly doesn't mean that you actually will make more money. You just get that dividend payment more often. You still get the same overall amount, but you do get to open up your investing app and see that you got a dividend a lot more often and get that little adrenaline rush. So guys, I really do hope that you enjoyed today's video. You were able to get something out of it. Hopefully I was able to put a company onto your radar you can go out and do a little bit of research on. If you did enjoy or you got some value, can I please again ask you to smash that like button? It genuinely helps the channel out so much. Without that like button, I'd probably still have like 18 subs. But anyway guys, have a great day. I will see you for tomorrow's video. Peace.